Hello.
Hello.
Yeah, am I
Yes, sir.
audible?
Yes, sir.
Hello.
Yes, sir. Yes, sir. Yes.
Yeah, I'm just sharing my screen. Just tell me whether it is.
Yes, sir. Slides over here, sir.
Is
Okay.
it visible perfectly?
Yes, sir.
All right. Thank you.
Welcome, sir.
Yes, Kiran bhai. How are you? आवाज बंद है सर आपका. It's muted.
Yes. Thanks to Nitin bhai, I could join this study circle.
Very good, sir. You are
Hello.
most welcome, sir.
Yes, thank you.
नितिन भाई. Yes, हमारे आज के स्पीकर नितिन भाई, वेलकम यू सर.
Thank you, sir.
કેમ છો નીતિન ભાઈ?
બસ મજામાં સર, કેમ છો?
બસ જો ફાઇન.
29 તારીખે ફરી પાછું બોલી રહ્યો તમારે.
29 શું છે હવે પાછું?
એક મિનિટ. હેલો. હેલો. હાજી. 29 તારીખે પિંપરી ચિંચવડ છું.
અચ્છા. હું નથી, હું નાસિક છું. મારા ભત્રીજીના લગ્નમાં જવાનું છું.
ઓકે.
I think that is on GST ને?
ના, આના પર જ છે, સેલ્ફ રીડેવલપમેન્ટ પર. સેમ
Okay.
ટોપિક.
ઓકે. તો એ નથી ખબર મને પ્રોગ્રામ. પણ 27 થી 4 આઈ એમ નોટ અવેલેબલ. લગ્નમાં બિઝી છું.
अच्छा ठीक है थैंक यू.
हेलो. हाँ ठीक है, दे दो.
Although it is already 6 o'clock, we are waiting for more members to join. Therefore, we should wait for maybe 2-3 minutes, and then we can begin.
इधर कोटक में ना चालू हुआ कि नहीं हुआ है? इधर चालू हो गया ना, तो इधर से निकाल सकते हैं. देखता हूं मैं. वीडियो ने देखा थे ये दिलीप भाई के. हाँ उधर.
Yes, I request all the members, please unmute yourself. This program is the study group program. It is your family program. It is your house program. I also welcome our convener Aditya ji. Hello Aditya ji, unmute yourself.
Hello sir.
उसको दे देना आपने. सेवन को 15,000 रुपए.
हमारे वाइब्रेंट
दे देना 15,000
साहब He is also very good contributor. Lalit Pawar ji, welcome you, sir.
Welcome, sir. Welcome. I'm out of office. Yes,
Okay,
I'm
no problem, sir.
noting
You are
myself.
here with us. I know.
Yes,
Whether
yes, yes.
you are out of office, who is at their office is least
No,
concerned
sir.
here.
For personal work, I'm out of my office.
Yes, sir. Yes, Rasmi ji, welcome.
Yes, sir.
You are
Thank you
from
so much.
Nashik, right?
No, I'm in Pune now.
From Pune. Okay. Yes, Rajesh ji, Vinayak ji, Nitish bhai, Akshay. It is your platform. Before we begin the session, we should have at least hi, hello with each other so that we can be more integrated with each other.
Yes, sir. Looking forward to a physical meeting at WRC, sir.
Madam,
we
you
can
promise
meet.
that you will come. I will announce. At least
Yes.
you promise, because we have very bad experience. We had once only speaker and the convener, deputy convener. 3 people were there.
Okay.
And that creates unworkability, in fact. When we have a big seminar or conference hall, and then managing all those facilities for members, and members don't have time to reach there. Yes, we would like to have, I will request all the members, please make your schedule and declare which date is most appropriate. Our meeting might be of 2 hours, and 2-3 hours we can meet each other in a very closely manner, so that that date should be a memorable date for everyone.
Yes, sir.
Aditya ji, now let us begin, right? Because the
Yes,
session is lengthy. Our
we have
speaker,
already got 25.
yes, we have got good numbers. In fact, I had declared more than 30 members to Bhuta ji. Actually, Nitin bhai, what happens in our study group, we have experience of 10 to 13, 15 members. But we have selected such a topic. Redevelopment is a very important topic, and there is no clear answer to anyone. And all the experts are also a bit confused about certain guidelines or some suggestions. And therefore, whenever such good kind of session happens, a maximum number of participants join this.
Okay.
And that is why we are here to listen you, because I know you have the various aspects which you can deliver on the redevelopment. It is not only RERA redevelopment, it is redevelopment might be related to income tax, compliances, society matters, it can be GST, it can be stamp duty, it can be somehow to the tenants or the owner or the developer, contractor. Various aspects are covered. JDA, and there are clauses in different JDA, different ways and means are adopted to take advantage in various ways. And I am hopeful you will, whatever you will deliver, I don't expect that you are specific about specific things, but whatever you will share will be very broadly and valuable for each members of our study group. This is what my expectations, and I know you will fulfill that. And before that, let me, Aditya ji, would you like to say as a convener something for the members? Then introduction I can give for Nitin bhai.
Yes. First of all, thank Dilip Agarwal sir for taking such a good initiative for the members and inviting such an expert and senior faculty, see Nitin Bhuta sir. I welcome you, sir, and definitely this is our privilege to have such a topic which is much confusing and is of great importance for this all the chartered accountants. And we have seen that nowadays redevelopment has, the importance of redevelopment has increased, and even the issues are increasing in redevelopment. So it is really our privilege to hear you, and really looking forward to hear you. And thanks once again, thanks Dilip Agarwal sir. We can definitely see the impact, sir. This is now still members are increasing. So such a great topic, sir. For 28, I have seen the highest number now till now. So it is good that members are interested in it. Thank you very much, Dilip sir.
Yeah, thank you, Aditya ji, for your kind words. And you are always a very inspiring convener and providing good leadership. And I think I am very much privileged that you being youngster, having good knowledge of the technology and the subject, and under your leadership, I am grooming up. Age is not a factor. Factor is the knowledge domain. And I always prefer people, anyone, and age is not the limit. We all are children. We are all studying and developing ourselves. Now I have one or 1.5 pager introduction profile, but I don't want to see this profile because Nitin Bhuta ji is very closely associated, at least for a decade. He is also from the same area where I live. He is from Kandivali. I am from Malad West. We are in the same study group, study circle. He is also core committee member in the study group, and he has delivered at various platforms on GST. He is master in the GST. When the GST topic was started, he was one of the person on the professional front in the C Institute. Anyone could ask any question. He was the one to answer immediately, and he had declared that not more than some time, maybe 1 hour or so, he will answer all those queries. And that is the kind of person we have today with us. In the last 5 years, his experience and his knowledge has grown like anything. And he's also having good knowledge about the income tax, and he's a good speaker, and he's taking care of the interest of the members, basically. Whatever we expect from him to deliver, he will deliver. With this very small introduction, he's, as you can see, very middle-aged, matured professional. This is one line introduction for him. And without taking much of the time, he said, I will be taking 2.5 hours minimum, seeing the topic. Then I have requested him कि आप 8 बजे तक का टारगेट रखना, क्योंकि हमारे मेंबर बीच में उसके बाद जाने लग जाते हैं, और जादू मंत्र आपके उसमें होगा तो आधा घंटा तो क्या 1 घंटा भी आप आगे चलाओगे तो चलेगा. But since this is the WRC platform study group, and we would like to maintain the timelines, and now this floor is yours, Nitin bhai. Over to you.
Thank you, Dilip bhai, for the kind words of introduction. Let me tell you, friends, I am not matured. I'm a novice person. I just speak as it comes to my mind. And I will just try to touch upon the specific aspects of society redevelopment, the topic which has been allocated to me. And I would try to cover same aspects from a conceptual framework background rather than going into a detail. During whole of my presentation, I will try to use the limited technical jargons wherever possible. Where it is not possible, I got to use, I don't have a choice. At the same time, I would like to use the few sections, though I have covered a lot of judicial pronouncements which can be relevant from the perspective of a self-redevelopment. But one word of caution for all the participants. Any judgments that you always analyze for the applicability to your clients, please read each and every judgment under lens, each and every words to be carefully examined, and then see if it is applicable to you or not. Because every judgment can be peculiar by itself. So just don't go by the header that is given in the professional websites. but study the judgment. And then if you feel it is applicable to a matter under consideration, you can apply. But if it is not applicable, my sincere request to everybody, don't touch that judgment at all. That is a caveat. So with this, let me start my presentation. And before I start my presentation, I would like to thank WRC RERA study group to giving me an opportunity to speak before you. And when the Dilip Bhai approached me to speak on this particular topic, I said, give me 1 day, whether I can take up this topic or not, because the topic is so challenging, intricate, and it confuses everybody, including me. But what I have done in this particular presentation, I have tried to express my views where there are similarities as well as the dissimilarities under the income tax and GST law, and wherever the extension of allied laws is applicable, I have tried to touch upon as a reference. So one can touch upon, because I think that is very, very relevant from the perspective of a self-renewal. Now its time is, according to my watch, is 6:16. And I will try to wrap up my presentation by 7:50 at the most. At the most. So that 10 minutes we can have it for the question answer session. I would urge all the members to be on a silent mode so that presentation can be done in a. So with this, I will start my presentation. Is this visible, sir?
Yes, it is visible.
Okay. So the proper topic is society redevelopment, conceptual framework from the direct and indirect tax statutes. Typically, all the speakers will put their disclaimer in the end, but I always put my disclaimer in the beginning. I'll always say that whatever I will say, it is my personal opinion. I may be correct or I may be incorrect. And whatever I'm going to make a statement, that is based on my understanding of the subject. It is not binding on study circle as well as the ICI. Each member is requested to go through the law provisions and then advise their clients suitably. And if I give any examples and they are similar to your clients, please note I have no intention to disclose anybody's affair in the public domain. Further, one more thing which I would like to talk on this subject. I'm not here to prove myself today on this intricate topic of redevelopment, but I'm here to improve myself today. And this is the broad outline of the points which I would be covering in my presentation. I will start with the foundation concept. Foundation is the base of the whole discussion, followed by the income tax concepts, GST concept, history of society redevelopment under income tax as well as the GST. What are the transfer implications? Consideration aspects of the self-redevelopment. What are the rates of taxes that are applicable? Input tax credit reversal provisions. GST on joint development agreements or a redevelopment agreements which arise on account of the transfer of development rights or a FSI or DA or whatever the nomenclature that has been regularly used, right in land or a building or a movable property. Capital gains exemption arising on account of the redevelopment of the property. At what point of time tax liability arise? and when is the time of supply as per GST provisions, and what is the taxability of the various consideration components that are paid to the existing members in case of the society redevelopment, method of accounting, revenue recognitions, accounting standards, ICDS, and the guidance notes as available for the real estate industry. Implication of Section 37 of the Income Tax Act in case of the society redevelopment in the hands of a builder developer, because essentially he is going to report such income under the profit and gains of business or profession to whom Section 37 is applicable. TDS implications in the hands of the existing members, new buyers of the in these development property, and the builder, and so on. Inheritance issues, bankruptcy and insolvency issues, and what is the way forward. So let's look at when I started studying this particular topic. It was like one would visit the South Pole, which I can say it may be an income tax, or a North Pole, which is the indirect tax, which we popularly known as a GST. So it was like going round and round. How do I arrive at a common conclusion on the topic of society redevelopment? Typically, when I look at income tax is more driven on a income base, whereas GST is driven from the aspect of the transaction value base. Under income tax, everything is centered around the PAN number of a taxpayer, whereas GST is dependent on the multiple locations that one has, and the tax treatment is given accordingly. So when I carefully look at some of the basic definitions which are given under the Section 2 of the income tax, typically whenever you study any particular law, you will always find the definition section is under Section 2 only. Typically, any law, typically you pick up. Income tax defines business includes any trade, commerce, or a manufacture, or any adventure, or a concern in nature of trade, commerce, or manufacture. If we look at this particular definition very closely, the definition which is given is an inclusive definition. And typically, when case of the society redevelopment, it can be one-time assignment, one-time situation that can arise, because that situation may not occur again and again. So it is a one-time. That's why I have highlighted the word adventure specifically for the purpose of the discussion. But when I correspondingly consider the definition of a business under the GST law, it also says business includes. So both the definitions are inclusive definitions. So whatever is stated in the definition, it can always have the multiple things that can be covered other than what has been stated in the definition. So when you look at the language that has been used, any trade, commerce, or manufacture, if you look at the same definition words in the income tax, the wordings are the same. But under GST, it is a profession and vocation. Again, the adventure is also used. But they have said major or any other similar, or it is whether it is for a profit motive or it is without for a profit motive. Plus, anything which is connected, incidental, or ancillary to clause of clause A can also be included in the definition of a business as per GST. Irrespective of the volume, frequency, continuity, or a regularity, still it can be held to be a business under GST. And that is the same logic that applies under the income tax law also. So here, let us examine can one of the transaction of a self-redevelopment, will it be covered under the definition of a supply? It will be covered because the definition given under the GST law is much wider in terms of the explanation that is provided. Plus, if we look at the amendment that has been introduced under section 7, which defines the scope of supply under the GST, section 171AA, even a society is now covered. So that activities will form part of the supply per se. But when we look at the Income Tax Act, profession is defined indirectly under section 44A, which says a specified profession means this. And any professions other than that notified professions will go into the non-specified professions. Further, income tax categorically defines the books of accounts. What does it mean? And a lot of changes have been incorporated in the Finance Act, whereby the electronic data is also considered as a books of accounts. But is there any specific provision under the GST law mentioning about the books of accounts? To my understanding, section 35 of CGST Act 2017, Rule 56 talks about the maintenance of the books of accounts, which is more or less similar to under the income tax as well as the corporate law or anything. And even if whatever the books of accounts that you are maintaining under the Income Tax Act would suffice for the purpose of the compliance of the GST requirements. Income tax again defines the cooperative society under section 219 to say it is a society registered under the Cooperative Society Act 1912 or any other law for the time being in force in any state for the registration of cooperative societies. Every state has a Society Registration Act invariably. But when we look at the clause E under the GST law, section 217, provision by way a club we are not concerned, association, society, or any such body. There, if a redevelopment activity is carried out, especially in case of the self-redevelopment of a society, we will touch upon that angle at a subsequent. But if that is done, and if the society is making the collections, then it would trigger the provisions of a supply as per section 7 of CGST Act. And to such collections, if it exceeds the threshold limit of 7,500 per month, then GST would trigger at the rate of 18%. But let us examine another two definitions which are very, very critical for the purpose of understanding. Section 252 of defines goods, which says every kind of movable property other than money and securities, but includes actionable claim, which are meant to be a goods. Similarly, services have been defined to mean anything other than goods, money and securities. Please mark these words very, very clearly. Goods means movable property, but it does not include money and securities. But services means anything other than goods. So if something cannot be categorized as goods, then it will fall under the limbs of services. So they have tried to cover all the activities which one can conceptualize, bearing some exceptions. to be covered under the provisions of the GST. So here that one thought that comes to my mind, which we will examine subsequently. Can we treat revenue sharing arrangements as a transaction of a money so as to fall under the exclusion as per section 2102, which defines services, or section 252, goods? I'm just right now parking this as a food for thought for all the participants. Now let's examine the definition of an outward supply. Outward supply under the GST means in relation to a taxable person. Outward supply can be only meant by a taxable person. It can be either of goods or services or both, or any combination. Whether by way of a sale, transfer, barter, exchange, license, rental, lease, disposal, or any other mode. But here we are concerned prima facie with the sale, transfer, barter, exchange, or any other mode. Sale, because in society redevelopment, if we are selling the property to the new members, it can be termed as a sale. In case of the old society redevelopment, if we are demolishing the building and transferring the rights to of TDR, it amounts to a transfer. And for considering the transfer of our development rights, we are getting a new property in the new building, which may be termed as barter or a exchange. And it can be any other mode. It can be you are getting a residential property, you are getting the corpus, you are getting the alternative accommodation cost, or a shifting allowance, or whatever we call it, nomenclature that we use. Made or agreed to be made by such a person. Here, it refers to only a taxable person. It means a person who is registered under the provisions of the GST Act. And if he is doing such a outward supply in the course or furtherance of a business, then it will be treated as an outward supply. Now here one thought that comes to me, can we correlate such similar terms with the transfer definition provided under the Income Tax Act? More or less the wordings that are used are more or less the same. And if you look at section 45 of the Income Tax Act, it is more or less on the similar footings, exactly similar footings. Look at carefully how the law has been drafted by the government. They take care of all the angles. And when I compare inward supply definition, that is also in relation to a person. But see, look at the difference between the outward supply and the inward supply. It has used the word taxable person, and here it has used the only word person, unregistered. Both. Shall mean shall. It is a restrictive word. Receipt of goods or services, both. Whether by purchase. It means if you are buying for a consideration, or you are acquiring in an exchange, or any other means, with or without consideration. Typically in society redevelopment, in exchange of the transfer of development rights, you are getting the new apartment, which is without consideration. Typically, legally it is not correct. It is without consideration. There is a consideration involved, but it is hidden. So here that question that comes to my mind, can a society be termed as a carrying on business as per section 270, especially the adventure? If it is going for a self-redevelopment, yes, it will. But if it is the self-development meant only for its member and it is not sold to the outsider, it cannot be treated as a business. It will be a normal extension of our repairing aspects of the society. Because it is not, we are not selling it to anybody. It is a self-construction of your old building. But if you are selling it to the external persons, then it will be a business. And then you got to do all the GST compliances that are applicable. And once it is treated as a business, registration, compliances, then it will be outward supply as per section 2, subclause 83, as we have seen, read with section 171 AA. So it will satisfy the test of in the course of business or a furtherance of business. These are the various terms which I have used in the whole of the presentation. Typically, if the terms are defined, because real estate is ultimately connected with the RERA, most of the terms are defined under the RERA law, and you people are the experts in RERA. Let me make it very open statement. I'm not an expert on RERA at all. I have hardly any knowledge on RERA, very limited knowledge. But whatever I have a reasonable understanding of the subject. But I'm not the authority on RERA. Neither I'm an authority on the conveyancing aspect, neither I'm an authority on the various aspects. These are the terms which I have used in the whole of the presentation. And one should contemplate, read, and this presentation would be shared with all of you after the session, as been notified to me by Dilip Bhai. So let's understand some of the fundamentals of society redevelopment. Society typically denotes a group of members staying in a common area, and they plan to go for a redevelopment because the buildings are old. And redevelopment typically also would include the development also. Why I have used the word development here? For example, if a society is owning only land, then it can be a development of a land by way of a new building superstructure, we call it as. But typically, what is the requirement of society redevelopment? Population is growing by leaps and bounds. Typically, most of us may have 1 BHK flats, but if the number of people in our family increase, we seek for either 2 BHK or 3 BHK, or if we are staying in one room kitchen, we aspire in well-maintained building infrastructure, all under one roof. Supermarket in the building society premises, medical store, all the basic requirements that one needs should be available at a doorstep, so that you don't have to go out. And that is where the structured developments is happening. Horizontal and vertical developments of the building, depending upon the area that is available for the purpose of the construction. Prices of the properties are increased so much. It is very difficult for an average family to buy a new apartment. So redevelopment is considered as the one of the way of buying a new property. Plus, land bank in the metro areas or non-metro areas of the tier 2 and tier 3 cities, land bank is always limited. So that if they have an extra FSI or a TDI, always one wants to explore such an option to construct a new building and stay in the new infrastructure options. Community living and social networking. That is also one of the reasons to stay in if we have the campus of the building is good enough, good people come, It helps mentally as well as professionally to most of the people. Plus government policy and support. When we typically look at the permissions that are required for doing any kind of a redevelopment, as I understand, as I'm subject to correction, at least minimum 70 legal permissions are required. And if the society is going for a self-redevelopment, society is given additional FSI by the government because of the policy initiatives. But we will visit whether why builder developer society redevelopment is more popular as compared to self redevelopment in the sub couple of next slides. When we look at the typical regulatory and the taxation aspects of the society redevelopment, government authorities are there. Various property laws are applicable for the purpose of the society redevelopment. Society being registered under the society law compliances have to be done because society has to function within the contours of the society law. They cannot go beyond that. But when we are doing a self redevelopment, it will have the accounting and the auditing standards implications. Any transaction which we do with the intention of a commercial motive will have the exposure to direct tax and the indirect tax. And typically, when the society is under the redevelopment phase, property may be sold before construction, because typically when we examine the under construction properties, the rates are more lucrative. They are much lower than the prevailing ready possession property. So it becomes more lucrative to invest into the under construction properties. So typically when the property is bought under construction, GST is definitely payable. Income tax is also payable on acquisitions as well as development. And TDS is also payable because you are buying. And TDS also, a builder developer who is developing that particular thing has to do the compliances as mandated by the respective laws of direct tax. But if that property is sold after the receiving the occupation certificate or a completion certificate or a first occupation, then GST is not payable because it is considered as a Schedule 3 supply of CGST Act. Schedule 3 to Section 2, Subclause 100 of CGST Act, which says that sale of land or a building or both is exempt from the levy of GST post occupation certificate. I will be using the word very commonly, post occupation certificate or a completion certificate or a first occupation is one and the same. Income tax is payable under both these scenarios. TDS is also payable under both these scenarios. So this is the broad regulatory and taxation aspect of a society redevelopment. Now let's look at the TDR. What is TDR? Basically, it is an infrastructure transition. You are going from old to new. So it is a transition. And whenever we look at any transition, some time is always spent on developing or building or redeveloping such a property. But from what is the source of TDR, transfer of development rights, or a floor space index, or long-term lease? Long-term lease typically refers to a lease which is given for more than 30 years. It can be given by the government authorities. For example, government acquires a parcel of a land for building up the road, and in exchange to that, if they give you a TDR rights, which can be loaded for the purpose of the development, and which is like a document for the which can be used for the purpose of construction. Or so landowner or a society, can they have their own extra FSI on which they can construct the additional floors and sell it. So whenever the TDR is acquired from the market sources, see, like somebody has got TDR from the government, he can sell it to the builder, and that is topped up for the purpose of constructing, because the required FSI is not required available. So that is done. All of a sudden, development control regulation rules change, and because of that, the TDR is also generated at times, which is also by the operation of a law, or it can be any other reasons. But when we look at the definition given under the Maharashtra Regional Town Planning Act, it means a right to carry out development or to develop land or building or both, and shall include transferable development rights in the form of a right to utilize the floor space index of land utilizable either on the remainder of the land partially reserved for a public purpose or elsewhere as the final development control regulations. So whenever we look at the legality of the TDR part, we need to always refer to the, since we are discussing Maharashtra, we will refer to the Maharashtra Town Planning Act. We need to examine that angle very, very closely. Or our councils, solicitors, whoever we have, they will examine this angle whether it is falls under that particular definition or not. So let's look at some of these. Who are the stakeholders involved in the society redevelopment? It can be society, members, builder, developer, or a project management agency, or a promoter himself, or it can be a self-development by the society, and new buyers and the government. Government is always party to every transaction that we do, whether we like it or not like it. If we have a land bank, society has a land bank, they can construct a new building, or if there is an old dilapidated structure, that can also be done by a redevelopment or a development, as we call. A new building that can be created, which can be visible in terms of the illustration on the right hand side. But when I look at the broad structure of a society redevelopment, it starts with the proposal. Anyway, proposal discussion takes a very long time to materialize because a lot of legal aspects has to be seen. Once the proposal formalities, the quotations, tenders, legal clearances, everything is cleared, the agreement is executed, whereby there is a transfer of a land or a transfer of TDR or a development right or a FSI in favor of the builder developer. After that process is done, statutory permissions are obtained from the appropriate authorities, which can be any local authority. Process of redevelopment begins. Either old structure is demolished or a new structure is built by laying down the foundations and everything. And once the construction is complete, occupation certificate is obtained, or a project completion certificate is obtained, or a first possession is given to the existing members or new members, depending upon the structure of business arrangements. So, but when we do a society redevelopment, before we execute any kind of a society redevelopment, always there has to be feasibility in terms of the technicalities, financial feasibilities, credit worthiness of the parties involved in that particular transactions, whether legal and title is clear to the property if the conveyance is not in the favor of the society, society redevelopment cannot be executed. And if the builder is given an opportunity to do the self-development, guarantee bonds or a bank guarantees by way of securities are obtained from the bankers, structure approvals are placed, quality controls are taken into consideration, regular monitoring happens, legal compliances are regularly provided. Here, whatever the legal permissions are obtained, it is always recommended that society should always keep a copy, one of the copies of all the permissions in their master files. Changes in the property records in terms of the area has to be properly registered. Final approvals are in place. Possession and the final closure of the. It looks very simple on the one slide, but the process is very, very complex, lengthy. It requires a lot of brains to work on the society redevelopment aspects. And let's now look at the way the compensation is paid to the existing members. New apartment is given with the extra area. Corpus is given to member as well as to the society. Permanent alternative accommodation arrangement cost is paid to the existing members. Shifting allowances are given and other considerations are also paid. This is the more or less nomenclature, can be anything. Every agreement can be peculiar, every arrangement can be peculiar. But at the same time, when we look at from a builder's perspective, construction cost, whatever has been paid to the existing members, it is a construction cost plus cost of actual construction, cost of all government permissions, legal compliances, contingency costs. And no builder will do any such kind of activity without the intention of making a profit. And that essentially profit is derived by him by way of selling the free area which he gets to explore because of the society redevelopment. Now let's look at some of the conveyancing aspects. Typically, agreement is a center around in all the society redevelopment, where the owner of a land or a society will have a ownership of the land. And typically, if society or owner transfer the land to the builder, then the benefits of society's redevelopment, which are available under the provisions of the Income Tax Act for deferring the tax liability, will not be available under section 45(5)(a). But if only the right to construct is given to the builder, then section 45(5)(a) benefit would be available. We will touch upon that angle, but just right now, take this. Here, there is an old circular which has been issued under the service tax, which said if there are tri-party agreements for the purpose of the construction of the society redevelopment, then it will be treated as if there is a construction services provided by the builder developer to the owner or a landowners. So that is very, very important. You got to see how the conveyancing is done, whether it is a bi-party or a tri-party agreement. So this is one of the fundamentals. If the ownership is retained by the owner of the flat or a owner of a land or a owner of the building, but only right to construction is given, then a lot of issues can be taken care substantially. But if it is a bi-party, two-party agreements, then probably the benefit of deferring the tax liability may not be available. So here let's look at how a consideration is paid. Let's look at a very simple example first to start with. Everything is paid in cash. So it will amount to a sale transfer. So it will be considered as a capital gain for the purpose of the income tax under section 45. So in which the income tax would be payable as per section 54 or a 54 exemptions can be claimed based on the period of holding. But income tax would be payable based on the period of holding more than 2 years or less than 2 years. GST will apply if it is applicable based on the residential, non-residential, commercial, whatever the aspects are. On kind sharing also, say instead of cash is also paid and the kind is also paid. In that case also, IT payable is deferred because of these special provisions governing under section 45(5)(a) of the Income Tax Act, as well as notifications issued under the GST Act, where the point to pay the tax is deferred to the year of possession by way of a occupation certificate, completion certificate, or a first occupation. And notification numbers I have flashed here. But here one more way of doing a revenue sharing. Can I consider that as a money transaction? Revenue sharing, we can explore not to pay the GST only in one route. It is either as a joint venture or special purpose vehicle. But otherwise, under any other scenarios, revenue sharing will trigger the GST liability. So that aspect has to be kept in mind very, very clearly. And more or less under GST, GST is payable under the reverse charge mechanism by the builder, developer, or a promoter. And these terms are defined under the RERA. So we have to take a support of a RERA to define who is responsible. And notification of 6th of 2019 decides when the GST is payable. Section 45(5)(a) decides when income tax is payable, in which year. And 45(5)(a) is only applicable only to the individuals and HUF. It is not applicable to any other assessees. Please keep that in very clearly in your mind. If it is a member is a LLP or a member is a firm or is a company, benefit of section 45(5)(a) is not available. It is only to an individual or a HUF. Please be clear in your mind. Typically, when we look at now let's compare the builder or a project management agency redevelopment vis-a-vis the society redevelopment. We know the cost to be incurred by our TDR, extra benefits, cost given to the existing members, and society on account of the redevelopment, legal permission cost, ancillary and the incidental, construction cost plus the contingency cost, taxes in the nature of direct, indirect, or any other taxes that are applicable, and plus builder will have the margin. But when I compare with the society self-redevelopment, the most difficulty that a society will face, they will not have the expertise which a builder has or a PMA has by a professional as well as the technical knowledge about the subject. If there are 100 society members, there is a brain ocean of 100 members. I don't know how a 100 member can come to a common table and reach a conclusion. There will be some people who will go against the purpose of the society redevelopment. Committed timelines and team members. If the professional managers are there, they can probably complete the development within a committed timelines. But if the society is doing a self-redevelopment, chances of doing within the time limit is very difficult, because everybody is not an expert. They may come across something which is surprising to them, because they have never seen such things, because they are doing it for the first time. It's a first time adventure. Resources of the societies are limited. Society has a sizable corpus, no issue. But if the corpus is not there, funds are required, how they manage. Whereas the builders can manage from their resources. Statutory permission, again, that is a big challenge. Time and dedication. Cannot people from a society dedicate time and efforts? Very difficult. Permissible FSI is a big advantage in case of the society self-development. As I understand, I'm not an authority on that angle, but as I understand, you get a better FSI as compared to builder redevelopment. Housing finance facilities challenges. If it is with the builder, getting a housing finance is very easy, but if it is a society redevelopment, finances becomes little difficult because there is no track record. So that is a challenge, but housing companies are giving the loans for the self-development also, and government is also encouraging that. The last but least, the society is doing a self-redevelopment. They have to do GST registration and the compliances. And GST law is so simple law that anybody can do any compliances by just blinking the eyes. Am I right, or am I just laughing? But one more thing, if we are doing a society redevelopment, builder's margin is saved in the hands of a society. Rest everything remains the same. There is no change. That all other cost has to be incurred. In fact, there will be more cost because builder can manage certain costs within a control, whereas a society as a self-redeveloper may not be able to manage. So let's look at the society redevelopment in the form of a joint venture and the special vehicle. Landowner and builder, they may incorporate a LLP company, pool their resources in terms of the land bank, in terms of the finances, and do the self-redevelopment. So please note here, joint venture or a special purpose vehicle is a separate legal identity. It is a separate person by itself. So all the compliances that a joint venture or a SPV has to do, it is separate. It is subject to tax, it is subject to GST, everything. But in that case, who will pay the income tax in case of the JV and SPV? On sale of transfer of land to a JV, section 45(2) of the income tax will trigger, and it is to be offered to tax according to the provisions of section 1. But it is subject to tax because one is converting his investment into a stock, and it is subject to tax accordingly. But out of the JV, after paying all the taxes, the revenue, whatever the profit shares are declared amongst the landowner and the builder, it will be treated as a transaction of a money, and it may not be subject to tax. But it's all depend how the documentation has happened. JV and SPV will pay the tax on its own as per the provisions of the income tax and the GST as applicable. But if it is a distribution of profits between the partners, say here the partners are landowner and the builder developer, on share of profit, GST will not trigger, plus it would be exempt under section 10(2)(a) of the Income Tax Act also. So this is the basic foundation of the society redevelopment as such. And these are the notifications which are essentially relevant for the purpose of the society redevelopment. Notification number 3, 4, 5, and 6. There is a typo error in the third row, which provides what is the rate of GST to be paid, what is the valuation of a construction service against the transfer of TDR, and which modified the notification number 11, 12, and 13, which were declared in the inception of a GST. They are all rate notifications. And it was notification number 4 provides the exemption for a supply of services to issue of OC, CC, or a first occupation. And it provides the mechanism to value the development rights also, linked to a stamp duty valuation. Notification number 6 provides taxability on a RCM basis by the promoter developer. It can be landowner, it can be builder developer, or it can be PMA as applicable. All depends how the business model is structured. And time is also notified when it is to be paid accordingly. But here the moot question is, whatever the society is earning, will it be termed as an income from other sources, or it will be treated as a profit and gains of business? See, if they are not selling it to the outsiders, it will be treated as an income from other sources. Whether taxable or not taxable, we will see in the subsequent slides. But if society is doing a self-redevelopment, then it will be treated as a supply. It has to collect the GST and pay to the government as applicable. One more recent development that has happened because of the judgment of Supreme Court in case of the Ahmedabad Urban Development Authority, or a new noble education, whereby especially it is very governing the NGOs, which may call it as a trust, Section 8 companies, or educational institution. If they have a land bank and if they want to go for a redevelopment, will GST provisions would trigger? Answer is yes, it would trigger. Whether registered residential flat owners can claim the benefit of the input tax credit under GST provisions for acquiring such residential properties or premises? Answer is absolute no. The reason is, property which we are acquiring, it is exempt from the levy of GST, and ITC on procurement of the residential premises, it is blocked under section 17(5) of the CGST Act. So ITC is not permissible. But say instead of the individual or a HUF, company or LLP or a firm is buying commercial premises, can they claim the ITC? Again, the answer is no. The reason is the same. There is no change. But one more, if a company, LLP, firm is doing the redevelopment activities for the sole purpose of letting it out, such residential or a commercial premises in future, can they claim the benefit of the input tax credits? Especially considering the judgment of the Safari retreat of Orissa High Court, which is pending in the Supreme Court, where the verdict is expected. But as of now, if we go, ITC benefit is not available. My answer remains the same, unless and until Safari retreat Supreme Court judgments give the other verdict. Another question, whether a cross-border transactions are applicable to cooperative society. Cross-border between the two countries, India, it can be firm LLP. But if you are, say, hiring the services of the architect or a landscape designer based from outside India, and you are making outward remittances from India, then section 195 of the Income Tax Act, read with section 90 or 90A of the Income Tax Act governing the double taxation avoidance provisions, would trigger. You need to do all the compliances like filing form 15 CACB and do the remittance. But RCM provisions by way of import of service would trigger under the GST law, which you can pay and claim against your GST liability payable. Last question for the basic foundation. If I'm doing a construction for my self-use, when I say myself, it can be individual, HUF, company, AOP, BOP, firm, LLP, anybody. Do I need a RERA permission? Since the intention is not to sell to the external persons, question of taking the RERA registration doesn't require. I'm subject to correction if I'm wrong, but to my knowledge, when I'm doing my own construction, I don't need a permission for RERA at all. Some of the income tax concepts. When the income tax came into the law from 1922, only individual HUF company and firm as a category was added. Income tax Act 1924 introduced the term association of person, which was replaced by the word in 1939 as association of, sorry, it was an association of individuals. It was replaced by the association of persons. There is a judgment of Indira Balkrishnan of Supreme Court, which defined what does mean by association of persons. But now, IT Act only uses the word association of person or a body of individuals. Plus, Section 219 defines the cooperative housing society and all that. But look at the similar definition under the GST. AOP or a BOI, whether incorporated or not in India or outside India, is also covered. So there are some people who are of the view in the public domain. If the society forms unregistered AOP, they can get out of the GST. So in my personal humble view, considering the definition of Section 284 under GST, they will be covered under the subclause F, and that way they will have to pay the GST. There is no option. Society as defined under the Society Registration Act 1860. Trust and every artificial. Look at the definition which are similar given under the income tax. Look at the definition given under the GST. They are more or less the same. But property can be in money, tangible things, or intangible. But when we look at the property, it is typically when we have an absolute possession with us, it is treated as an absolute property. And whereas a qualified for the property, where the possession is doing, if some qualification is not honored, then the possession of the property is lost in the hands of a person. But intangible, typical, is in the form of a TDR, FSI, and development agreements. And if I look at the Benami law property also, it defines property means property of any kind, whether movable or immovable, because the word property is very, very significant. It is widely used under the income tax as well as under the GST law. So one has to understand property in a perfect manner. Look at now this definition of scope of supply, which is governed under the Section 7 as well as Section 221 of the IGST Act. All forms of supply of goods or services of both, such as sale, transfer, barter, exchange, license, rental, lease, or disposal made or agreed to be made for a consideration by a person in the course or the furtherance of business. 7(1)AA, the activities or transactions by a person. We have seen the definition of a person, which covers the society also, or a AOP or BOP also, other than individual, to its members, or constitutions vice versa, for cash, deferred payment, or other valuable consideration, will get triggered as a supply as per Section 7. So earlier, and this is basically the amendment that has come because to reverse the judgment of Calcutta Club, which was introduced, given on the principle of mutuality. But now that is no more valid. GST is applicable. And there are various schedules referred to the CGST Act 1, 2, and 3, which says what kind of activities are governed under which particular schedule. We will see in the subsequent slides. But this definition is very, very important in the context of society redevelopment, which defines composite supply means a supply made by a taxable person. Remember the definition of an outward supply? Taxable person is also used here to a recipient comprising two or more supplies of goods or services or any combination thereof, which are naturally bundled or supplied in conjunction with each other in the ordinary course of business, one of which is the principal supply. So when we talk with reference to the society redevelopment, building redevelopment is a principal supply, and all other compensation that is given to us like a corpus or a shifting allowance or a alternative accommodation allowance, that is all ancillary supplies. So it can form part of the composite supply. Mixed rate, mixed supply is not applicable to us, but this is where the both are independent of each other, but they are supplied together, which provides key in case of the mixed supply, highest rate of tax will apply. For example, one supply attracts 1%, other is at 12%. Then for the purpose of billing, 12% will be livable. This is schedule 1. Typically, we are not concerned with that schedule at all, but here any supply made without consideration can be covered as a supply as per section 7 for the purpose of the GST compliances. Especially the branch transfers and everything is included here. Schedule 2. Activities that would be considered as a supply of goods or supply of services. Here, since construction that we are doing is not a goods, it will fall as a services and it will be termed as a work contract service, which is defined as a construction service under section 2119 of the CGST Act. And that is where under construction property sale would be subject to tax under schedule 3. Schedule 3 says it is neither a supply of goods, neither supply of services. So it is out of the levy of GST, which is like sale of a land or a sale of a completed building. So that is the essential reason in case of the completed buildings, no GST is payable because it is covered under schedule 3 of the CGST Act. So when we look at is GST applicable only to a business transaction? Typically, yes, but even an adventure in terms of the business can be treated. It can be supply. If it is not a supply, no GST. If it is exempted, then also no GST. If it is done within the state, then the CGST and SGST applies. If it is done between the states, then IGST would trigger. But typically, immovable property is always CGST plus SGST. If it is a single supply, then whatever the rate is applicable to a single supply will apply. If it is a composite supply, then whatever the tax rate that is applicable to a composite supply, that will trigger. And for a maximum mixed supply, maximum rate would trigger. Now let's look at some of the history aspects. When I say history, it is a history, it is not applicable today, but for the purpose of the understanding of the subject, history is very, very important. Earlier, as soon as you sign the document of development, income tax was payable. For example, Mr. A wanted to give the development rights to Mr. B. He signed the document and the income tax was payable, but poor fellow did not have the money. So how will he pay the income tax? That is applicable. And this is the old judgments of Bombay High Court and the advanced rulings of New Delhi, which supported that view. Thereafter, the Punjab and Haryana High Court gave a very nice verdict. If that agreement of transfer is registered, then only it is subject to tax, otherwise it is not subject to tax. And registration means section 17 of Registration Act 1908. So that was a reprieve, because a lot of people used to sign the agreements, but they were never not registered. So they got a reprieve from the payment of tax. Again, part possession as per the section 53 of the transfer of property also triggered the GST income tax liability. When we look at the erstwhile law, which is a service tax law, it provided entry 9 of list 2 of 7th schedule, which authorizes under Article 246 to the state to tax the transaction. But service tax clearly said the activity of transfer of title in immovable property is excluded from the levy of GST. Service tax. Term immovable property was never defined, so one has to go to the General Clauses Act. There was no specific provision qua TDR prior to 25th January 2018. But now, today, whatever we will discuss is the TDR is taxable from 1st April 2019. Notification number 4 of 2019. Old judgments, which said the development rates are akin to land, hence not subject to tax, do not hold port anymore. That is Cheda housing. So they have builders, DLF commercial projects. Now let's look at the definition of a transfer. Transfer is defined. Before we go to transfer, let us see what is the definition given for the capital asset. Property of any kind. Property can be movable or immovable, held by an assessee, whether or not connected with his business or profession. Both can be capital asset. But Section 247 defined transfer, sale, exchange or relinquishment of the asset. If that is triggered, 45(1) is triggered and that gain is subject to tax. If there is an extinguishment of the any rights, then also it is subject to tax under 45(1). 247(4), in case where the asset is converted by the owner thereof into or by him treated as a stock in trade, then also on conversion or a treatment 45(2), and the point of paying the tax is deferred as per 45(2). Here, supply definition we have already seen. Calcutta judgment was essentially on the Article 369(2)(a), whereas GST is governed by Article 246(a), 269(a), and 366(1)(12)(a) of Constitution of India. So Calcutta judgment will not hold its fort, and the GST will trigger. In 247(5) provides any transaction involving allowing of possession of immovable property to be taken or retained in part performance of contract of nature referred in Section 53(e) or Transfer of Property Act, which is governed by Section 45, subclause 5(a). We will see in subsequent time. Even a society is covered under the clause 6. But here, now we have seen the definition of a composite supply. So if the consideration for the transfer of development right is paid in a different form by way of a TDR or by way of a new constructed flats plus corpus plus shifting plus alternative accommodation cost, can we apply the principle of a composite supply saying that principal supply is a redevelopment of the property? And so whatever the rate that is applicable of GST, that should apply. Typically, GST rate is 1% or a 5%, depending on the affordable housing or a non-affordable housing, or 1.5% or a 7.5%, depending on the structure. Can we take a stand? in my opinion, humble opinion, it is definitely a composite supply, because paying the consideration in a different form is only a commercial part, but essential objective of executing the agreement, the development agreement, and how the money is paid, because typically it is like, giving in the installments to the existing flat owners is the commercial part, which involves the money, but the consideration is triggered. And if we register the development agreement, whatever the benefits that we are passing on to the members, that is also considered for the purpose of the stamp duty valuation. So even I draw the support from that perspective, I will go with the composite supply only and take a stand accordingly. And immovable property is defined under the 269 UA of the Income Tax Act. Supply 1, we are not concerned. We are concerned with Schedule 2, construction services, which will come under the entry number 5B. And Schedule 3, where a sale of a building. But here one more question that comes. If I'm transferring my part of a land or a part of a building, will it get covered under Schedule 3 so that I can say it is not subject to GST? The answer is yes. The reason is there are enough judicial pronouncements that are available, which we will see in the rights in land and building, which says the whole includes the part also. So that analogy can be applied and we can claim the exemption for that also. There is one more situation that can come, which is key. Before the receiving the occupation certificate, if the property is sold, then what happens? We will touch upon that in the subsequent slides. This is the judgment which has come just now, received before the session, which says where assessee entered into a development agreement with a developer, since merely assessee gave a right to developer to enter into a property for the purpose of the construction, via the said agreement, and refundable deposits from developer and advances from the prospective buyers were received consequent to said agreement, provisions of section 247 would have no implication. So when we are drafting the development agreement for the purpose of the society redevelopment, utmost care should be taken to provide the right to develop the property does not amount to a transfer as per section 247 of the Income Tax Act, and it should be clearly worded without any ambiguity at all. And I think if that has been taken care, it will help society also, and it will help to take care of the income tax requirements also. But there is one more situation which I would like to touch upon. If the land that is transferred as per the land records is agricultural land, and agricultural land can be rural agricultural land or urban. And if that is transferred to a builder developer and then he converts that into a non-agricultural land and then he builds the premises, will it subject to tax? It is not a capital asset at all. Because of that, rural agricultural land transfer will not attract the income tax provisions at all in the case of the individuals and HUF only. And in that case, section 45(5)(a) doesn't apply. And various kilometer limits and the population limits are provided in case of the agricultural land. So 7/12 extract of the land record is to be examined very closely if such thing is. But if it is a urban agricultural land, which is not an agricultural land, but it is used for the agricultural purpose, then section 45(5)(a) will trigger if such land is used for the redevelopment purposes. These are the various definitions I'm not touching because I want to finish the presentation. Very important here. Long-term capital means a capital asset which is not a short-term capital asset. Short-term capital asset means that it is linked to a period of holding of 36 months. And in case of the land and building, now it is reduced to 24 months. Here one more food for thought. If a society is handing over the possession, will it amount to a transfer to attract the income tax? If we document it properly and say if we are not transferring the ownership of a land, then it will not amount to a transfer. But then section 45(5)(a) will come into the picture in case of the individuals and HUFs. Again, TDI document or a development agreement that we execute, if it clearly says ownership is not transferred, so even though because of the JDA agreement or a development agreement, ownership is not transferred. Here there are some people who say, can a society member, if they want to go for a self-redevelopment, say 50 members are there, they say we will pay 10 lakhs each as a corpus fund to the society and do the redevelopment. First of all, to my understanding of the Society Act, corpus fund cannot be paid by the member to the society at all. And even if it is paid, for the argument's sake, it is permitted for some reasons, still it will be subject to levy of GST. You can't escape. Can a society, since the corpus is not payable, can we give the advance deposit to the society for the redevelopment? Again, advance deposit is permissible, possible, if and only if permission from the society register is obtained. That is a very lengthy process. It is possible, but without conveyance, society cannot go for the redevelopment at all. But if the conveyance is not possible because of the various reasons, society always can go for a deemed conveyance and then go for a redevelopment. So conveyance or a deemed conveyance in the name of a society is the must. Without that, nothing can happen. Let's touch upon the definition of a consideration. Supreme Court in 1961 defined adequate consideration means a good consideration. Again, Supreme Court in case of the Harinder Singh defined adequate consideration denote consideration other than mere love and affection. So here the consideration when we talk with reference to a society redevelopment is a transfer of development right, and against that you are getting a new premises, so it is in kind. And if we look at the provisos which are recently introduced to the Income Tax Act, it always discourages the cash. It only is either check, electronic form of transfers, ECS, NEFT, RTGS, and corresponding disclosures in the ITR depending upon the property disclosures or various kind of disclosures pertaining to the cash transactions are required to be reported. And if we look at the reference of consideration, Section 50C, 50CA, 50D, 43CA, 43C, 45, 269 UG, UH, and Section 180A of the Income Tax defines the consideration. Section 231 of CGST defines consideration: any payment made or to be made, whether in money or otherwise, in respect of, comma, in response to, comma, or for the inducement of the supply of goods or services of both, whether by the recipient or any other person, but shall not include subsidy given by the central government or a state government. So can we say if the TDR is allotted by the government on account of the acquiring the land or on account of the changes in the development control regulations is a form of a subsidy, and that is outside the levy of GST. In my opinion, it is because of the town planning and everything. It will cover under section 243W, and because of that, in my humble understanding, we can take that as not subject to levy of GST. Or another angle, monetary value of any act or a forbearance. Since you are giving a property for the purpose of the redeveloper, you are forbearing and acting to accept whatever they want to do. That will also be covered. Again, subsidy is also excluded here. Deposit we have touched upon earlier, but deposit under GST is subject to tax only in the year in which it is offset to tax. So here GST liability would be deferred accordingly. And we can draw support from schedule 1, 2, and 3. Section 45 is the capital gains, which most of us would be aware. 45.2 talks about the conversion of an investment into stock in trade, and it is subject to tax in the year in which ultimately the stock is sold. This we have touched upon in the earlier slide, but is a corresponding only reference. This clause is very important from the society redevelopment perspective. Notwithstanding anything contained in subsection 1, that is 45.1, which is the charging section for a capital gain, where a capital gain arises to an assessee, being an individual or a HUF. If it is a company, firm, LLP, all will go either under 45.1 or 45.2. They cannot come in 45.5A at all. Being a land or building or both, under a specified agreement. Specified agreement means development agreement. The capital gains shall be chargeable to income tax as an income of the previous year, in which certificate of completion. Mark the word certificate of completion for the whole or a part of the project. So schedule 3, what we were referring, land or building or a part of a land of building, that is also support is available here under the law to take a stand. From a competent authorities, which is the municipal authorities or a architect or whoever defined, and all competent authorities are defined under this respective law. Stamp duty value on the date of issue of the said certificate of his share being land or building both in the project, as increased by the consideration received in cash. So now recall the definition of a composite supply. We can draw the support from here also. It is a composite supply so that we can correlate both the concepts under both the laws. Shall be deemed and to be the full value of consideration received or accruing as a result of transfer of capital asset as defined under section 214 of the Income Tax Act. Now let's look at the GST notification. Notification number of 12 of 2017. Service by way of a transfer of development right under serial number 41A, which is referred as a TDR or a FSI, on or after 1st April 2019 for a construction of a residential apartment by a promoter in a project intended for a sale. Here, intended to a sale to a buyer. So if it, the intention is not to sell, then that is not, this provision do not apply. Wholly or partly, except when the entire consideration has been received after issuance of the completion certificate. from a competent authority or after its first occupation, whichever is earlier. Look at the similarities between both these sections. Both the notification. Please understand GST is more or less governed by the changes in the notification that are introduced every now and then. So again, there is a proviso to section 45(5)(a) says कि assessed transfers is share in the project on or before the date of issue of the said certificate of completion. When I say completion, OC, CC or a first occupation. Capital gains shall be deemed to be the income of the previous year in which such transfer takes place. So if an existing member is transferring the flat before receipt of the occupation certificate, then he will go out of 45(5)(a) and he will go into section 45(1). He cannot claim the benefits of section 45(5)(a) anymore. So deferral of tax does not happen in that case, which we typically refer to a right in a property. So under GST, what happens? If an existing member is transferring that property, will it be subject to levy? I think we can definitely draw support for the sale of a personal jewelry, for which the press release was issued in July 2017. It is not subject to, it's not a supply, it's not a furtherance of business. And similar clarification was issued under the service tax regime also. That support can be drawn for the purpose. It is not a transaction for the furtherance of business, so it is not subject to GST at all. So that stand can be taken. So again, what do you mean by specified agreement? Everything has been defined under this section itself. Each one of us has to read the sections very closely to reach any conclusion. If TDR is allotted to the society due to changes in DCR rules, will such allotment would tantamount to supply? In my opinion, no. It will be treated as a government subsidy under the town planning measures. So that will not come to supply. But when you sell, it will be treated as a TDR and it will be subject to tax on the reverse charge basis on the receipt of OC, CC or a first occupation, as the case may be, if this society goes for a redevelopment. Income tax, we know, based on the period of holding of more than 24 months for a immovable property, long-term tax is applicable. And if it is less than 24 months, it will be treated as normal rates of tax. There is no change. It will be increased by surcharge. Further, it will be increased by the sales as notified. And for all other income, normal rates as applicable. For GST, residential property GST payable by the promoter developer. Affordable housing 1% without ITC. Non-affordable 5% without ITC. Can we say there is something entry called affordable housing 1.5% without ITC? The answer is, if the ownership of a land is not transferred as a part of the transfer agreement, development agreement or a specified agreement, then the rate of GST will be 1.5%. And for non-affordable, it will be 7.5%. Commercial property, 12% with ITC, 18% with ITC, where land is not transferred. Residential property, in respect of the unsold flats, 5% RCM will be payable in case of the real estate project or residential real estate projects. Commercial, 18% under RCM on the date of acquiring the such TDR. This is the new structure applicable from 1st April. There is no option to go for anything else, either 1% or 5%, depending on the classification. But in case of the real estate RREP, if the commercial area of the residential project, carpet area is less than 15% of the total carpet area, then it will have the rate applicable at 5%. Otherwise, for a commercial, 12% with the ITC. And this is the old structure, which most of us now not concerned because we are in 2022. But still, for the purpose of the comparison, I have given this particular thing. All new projects has to go under the new schemes only. GST to be paid only in cash, no ITC set off. ITC availment restricted only sale of commercial apartment with the 12% levy. No other transactions will have the ITC availment benefit under section 16. But reporting of ITC not availed as eligible has to be reported in the clause GST and 3B. Reversal of availment of excess ITC as on 31st March 2019. RCM on JDA by the builder developer on the receipt of OC, CC or a first occupation. 80% stipulation is provided for the procurements of inputs, capital goods and input services from registered taxable persons only. If we are making any RCM payouts, they are considered as a registered procurement for the purpose of the 80% calculation. What is excluded? TDR. If we treat composite supply components of the redevelopment cost as a TDR, then we are out of that 80%. Long-term lease premium, salami, FSI, electricity, high-speed diesel, water spirit, natural gas. If procurements are less than 80%, then shortfall. It will attract the levy at 80% under RCM. It is to be paid on or before the June of the next financial year on a project completed project basis. Only exception provided if the cement is procured from the unregistered dealer, then it is subject to 28% RCM. But moot question comes, why 28%? First of all, cement is subject to levy at 28%. Secondly, a lot of builders do a notorious activity of taking the bogus bills of cements, where the actual supply is not received. And because of that, this 28% is provided by the government with a conscious reason. This is the basic reversal of the project which was to be done as of 31st. So very simple. If you put it into this particular format, you will know exactly. Here, percentage of completion method, how you do, that will determine. But if you typically look at everything, they have mashed to 100% tally. Formula looks very complicated, very complicated at the first reading. But when you start putting the numbers in the respective tables, probably it is the easiest way of what reversals has to be done. Anyway, March 19, most of the things are complete. So this is more of a academic discussions, but it's not applicable. This slide, which I'm going to discuss now, is the most slide from a joint development agreement. I want everybody to pay 120% attendance or 200% attendance on this. It is applicable for transfer of development rights, FSI, DL, or a long-term lease, either on an area sharing basis or a revenue sharing basis. Property with or without land. It can be old building, new building, freehold, leasehold, SRA, tenanted. All types of properties are covered. Typically, society redevelopment happens when the property is more than 30 years and as per the structural audit report and so. If it is a affordable housing, in metros, the limit is 60 square meters. And non-metros, the limit is 90 square meters. But one more thing which is to be done is the consideration as per the agreement has to be less than 45 lakhs. Then 1% without ITC, 1% without ITC if it is without transfer of land. Notification number 3 of 2019. Most of the cases, 45 lakh rupees is not applicable in the city of Mumbai at all. But for the academic discussions, let us assume that there is affordable housing. Who will pay? RCM or the GST? Developer. But when developer is doing the costing of the project, he will consider all this angle and then he will price his product accordingly. Another is residential plus commercial, which is where the commercial is less than 15% of the total carpet area. Where the consideration is less than 45 lakhs, then also 1% and 1.5%. Non-affordable in either REP or RREP, all other areas, consideration is more than 45 lakhs, 5% without ITC where the land is transferred, 7.5% without ITC where land is not transferred. Common notification, and if it is for the commercial also, if the consideration is more than 45, then the 5 and 7.5% applicable. And if it is a commercial premises you are selling, consideration any value, it can be ₹1 also. 12% without ITC or with ITC. It is with ITC. It's a typo error here. Notification number 11 of 2017. And if you receive the occupation certificate or a completion certificate or a first occupation, time of supply is triggered as per the provisions of CGST Act. Whatever the unsold properties are there of the residential apartment or a commercial apartments, TDR value you will compute based on the nearest value of sale of independent buyer or nearest sale, multiplied by that is the rate you will take per square feet, carpet area rate, unsold area multiplied by 18%, divided by the total carpet area of the project, which includes residential as well as non-residential, depending upon the classification, or 1% or 5% of the total project value, whichever is lower. And project value for the commercial, it will be 12%. So maximum that one has to pay as the RCM is 1% or 5%. So that is the thumb rule which one has to take into consideration. One more thing. If a initially the project is classified as affordable housing, then the contractor will bill at 12% to the builder, developer. But later on, if it is seen, it does not remain as affordable housing, but it is converted into non-affordable housing. In that case, difference of 6% is to be paid by the builder developer on the contractor charges as the RCM liability. That is in addition. So these are the points which one should keep in mind while doing the audits of the real estate projects typically. And this is the final sheet which one should keep in mind. Only that error is that 12% with ITC, 18% with ITC is not without ITC. Without ITC is wrong. It's typo error. Now let's take some of the examples of right in land or building. Dilipji, am I exceeding time?
You can, I think you should carry on in the interest. Very important topic you are continuing.
Take it, sir. Okay, give
for
me
some time you continue.
20 minutes, sir.
Okay, okay.
Rights in land or building of a immovable property. Section 50C talks about the special provisions of a full consideration. Land or building. But when I refer to the immovable property definition given under section 194 IA, it also refers to a part of a building. And judgment of Kolkata High Court in ICI, whole includes part, greater contains the less, omne majus continuant is C minus. Bhagirath versus State of Punjab, again that judgment will support, draw or support. Here, proviso to section 50C also talks about the similar nature, how to value that particular thing. And further proviso is provided how the consideration has to be realized. This is basically a SAR provision, anti-avoidance tax law provisions, but part of a building is also included in the land or building is supported in the various sections quoted under the Act, section 27, 32, 50C, and so on. And even if you look at the exemption benefits that are available under section 54 and 54G, 54GA, building or land or any rights in building or land are defined. 50C is not applicable to rights in land and building. There are host of judgments. There are some judgment which says it is applicable also, where the land was transferred as a part of the development agreement. But you got to read each judgment with under the lenses and then only apply, don't apply blankly. So you will find the judgments which are contrary to the one thing, but so you have to, each facts of the case are different. 50C is not applicable to tenancy rights and leasehold rights because it only refers to land, building, or both. There is no such provision under the GST unless until section 15 triggers because of the valuation issues. Then rule 27 to rule 30 will trigger. This is again very important. If you are selling the residential property of more than 24 months old, it will be a long-term capital gain. Exemption benefit is available under the section 54, where I got to invest only the capital gain amount in for the claiming the exemption. Time limit is provided. You can acquire the property 1 year before, or you can acquire within next 2 year property, or under construction property next 3 years. But only thing, if you are not acquiring before the due date of filing the IT returns, then you should deposit the money in the capital gains unit scheme. Here one more issue. Do I need to deposit that, acquire the property before 139.1 or 139.4 or whether before 139.5? There are enough support is available from a different circulars which says if the property is acquired before all the timelines, then it will be a suffice compliance. Fair market value as on 1st April 2001 can be substituted if it is acquired prior to 31st March 2001, or agreement value whichever is higher, or if it is acquired on account of the gifts from a previous owner for which the consideration is not paid by the taxpayer, then that cost can be substituted for the purpose of the capital gains calculation. Commercial properties, especially which are given on a rent on which the depreciation is not claimed, the benefit of 54 will be available. 54F will be available, but not be 54. But only drawback of 54F is that one has to invest the net consideration. Thus, the condition remains the same. There are other restrictions are also there, but 54 there is. But if it is a business property, 50C will trigger. Either it will go in the block of assets or it will be a short-term capital gain. And anything other than the land property, land or building or a property, then section 54F will trigger. It will be covered under the 54F also. There is, let's one more example. I bought a land, I constructed the building. My period of holding is more than 2 years for land, but for building construction is less than 2 years. Is it a long-term capital gain or a short-term capital gain? There are many judgments which are available. For a land, it will be treated as a long-term capital gain. And because of that, the exemption will be available under the respective sections. And again, this judgment of Smita Shah has come day for yesterday. So that can be used as a support. 45(5)A we have already seen earlier. Notification number 3 links the valuation of our property with the stamp duty valuation. That is to be kept in mind. (45)(5)A only individual and HOF. It says that tax would be deferred in the year in which the occupation certificate is received. Under GST also, more or less it provides on the same lines. This is what I could draw the similarities between the income tax and GST. Here one more thought. Section 48 provides explanation. The index cost of improvement means any amount which bears to the improvement the cost proportion as a cost inflation index for the year in which the asset is transferred near to the total gain. So instead of agreement which I have done in 2019, but possession I'm giving in 2022, can I apply cost inflation index of 2022? Here the basic crux is we can take a support of section 45(2) in the following judgments, where it is given he held the benefit of indexation till the year of taxability of capital gains can be claimed, even if the capital gain arose in earlier years. It means that 2019 I have signed the development agreement, still I can take that benefit, but that is given with reference to section 45(2). And again, circular number 79 has given that T for 54EA, or if you are 51EB or so and so, such stand can be taken. But still, water has not been tasted for 45(5)A, but in my opinion, there is a good chance that we can take that difference. There are 3 views: capital receipt not taxable, part of the capital gains. So value consider for 45(1) or 45(5)A as the case may be, or income from other sources. This is, we have seen it earlier also. Composite, I go with the composite supply. So I will treat as a part of capital gains and treat it accordingly. There are various judgments available on the points of reference which can be used. But if a corpus is received by the society, BC Srinivas Setti still holds the hoop, because TDR is not defined under section 55(2). So where the quantification is not possible, where the calculation is not possible, mechanism fails, so such transaction cannot be subject to tax at all. And there are other judgments which are available on this particular point. Sale of to the additional area, same as the sold to the other members. Sale explanatory, I'm not spending much time on this. Accounting, this is very, very important. Basically, 2 kinds of valuations are available: percentage of completion method or completed contract method. But when we look at the provisions of income tax, section 43CA or 43CB for a construction contract or a 50C, percentage of completion method is accounting standard also provides same thing. But if I look at the Ind AS, it has provided for the completed contract method, but thereafter the clarification is provided the even Ind AS percentage of completion method can be followed. ICDS is also that only, but there is no specific ICDS for real estate transaction. Guidance note is provided for the real estate transactions, which also provides for the percentage of completion method. There is no guidance note available for the builder as such. Very, very important. This change which has come from assessment year 22-23. If a builder makes a smallest mistake of any legal permissions, then the whole of that cost would be disallowed under section 37, and consequently ITC claim under section 16 also, if it is applicable, 99% is not applicable because builder is paying 1% or 5%, but if he is claiming for a commercial property 12% ITC or 18% with ITC, then that can create the issue. This is the just a reference which I made. TDS under Income Tax Act 194 IC, wherever the agreement is registered under section 45(5)(a), 10% TDS is to be deducted. So any other compensation paid to the existing member, TDS should always be deducted under section 194 IC, so that you can always say it is a composite supply and it's a part of my TDL cost. But section 194 IA says where we are doing the purchase of the property, 1% TDS is to be deducted at the time. 194 is for the normal rent. But here, explanation is provided. Rent means any payment by whatever name called, any lease, sublease, tenancy, or any other agreement or arrangement for the use of land or building or both. So here the next question that comes to us, will the TDS required to be done on the exchange value of the flat under section 194 IA? In my opinion, since on account of the society development, there is a transfer of old TDR rights and the building is demolished. It is a extinguishment of the property, but because of section 45(5)(a) provisions, tax liability under income tax is deferred as well as under GST deferred. TDS under section 194 IA will trigger because only exclusion that is provided is a TDS on payments of compensation on acquisition of certain immovable property, which is a compulsory acquisition of the immovable property. So there is no other exemption, but as of now, today, nobody is deducting TDS under section 194 IA on account of the society redevelopment, but in my opinion, it is applicable. Whether builder is paying alternative accommodation cost of a rental, will he deduct the TDS under 194I? In my opinion, he should not deduct under 194I, but he should deduct under the agreement clause, which we have specified as 45(5)(a) at 10%. Rate remains the same. That will be a better defense from many aspects. I see if agreement is not registered, will I deduct the TDS under section 194 IC? In my view, if the agreement is not registered, 194 IC doesn't come into the picture at all. Inheritance issues. I'm just touching upon, it's a topic by itself. If the existing member dies, then what to do? If the person has died, has he left the will or without will? If will is left, what is the genuineness? What is the authenticity? Hindu succession law, if the person died is a Hindu, and if it is from any other community, then Indian succession law will provide. Probate is compulsory in the state of Maharashtra, Tamil Nadu, and West Bengal. In rest of the country, probate is not compulsory. Letter of administration works. No nominee only has a right to facilitate the transfer. He does not become the owner of the property. Builder and society has to put together complete all the formalities. If there is an attachment of the property because of some legal reasons, it's another challenge. Sale of under construction by legal hai. All precautions has to be taken. And if the member is a non-resident, whether proper power of attorney is registered in the court or not, that is to be seen. Whether FEMA provisions are applicable, double taxation avoidance treaties are applicable as per Article 6 of immovable property or Article 13 of capital gains or MLI. Article 9. That examination has to be done. Insolvency and bankruptcy. This is the biggest trouble. If a builder is not able to complete the project, or he is declared as an insolvent or bankrupt, home buyers can file the application for registering corporate insolvency process. Has to be minimum 100 members or not less than 110% of the home buyers, whichever is less. If existing member is declared as insolvent, then what happens? If no new buyer is declared as insolvent, what happens? If society is declared as insolvent, I don't think it's just a brain thought. Garnish proceedings under PMLA or a Benami or a black money, then what? Any other implications? In future, in my personal view, there is a requirement to simplify the law governing such a redevelopment process, probably single window clearances of all the requirements. If additional compensation is paid through bitcoins, then another set of compliance. Now we have a virtual digital asset that compliance will trigger. And if once the central bank digital currency is introduced, it is paid in that form, should not create any problem. It's normal bank currency valid. Can we expect a greater clarity on the valuation provisions? In my opinion, yes, we should expect. In my opinion, it is an additional area of professional opportunity. We can expect more litigation to flow because of the complexity involved in the transaction. Can we really state the provisions under the income tax and GST law are easily intelligible and applicable? Answer is no. It is very difficult for a common layman to understand. Will South Pole and North Pole extremes between the statue persist? How do we bridge the gulf? Wishing the very best to all the members attending this session, if they are considering or carrying out redevelopment, or where their activities societies are intending or carrying out such development, or they are discharging their role as an advisor or a consultant to catalyze the actual realization of dreams of so many of us, breathe who pray and hope that they can soon occupy their new abode like this as their dream house. Let me reiterate once again, I was not here to prove myself today on this intricate topic of redevelopment, but due to interaction with all the participants, I have improved myself today, certainly. I give the credits, and with this, I hand over the position to the.
Yeah.
Sir, I have a question.
Nitin bhai, first of all, really it is worth to attend your session.
I have a question, Dilip bhai.
Sir, 1 minute, he is coming. Just a minute. First of all, Nitin bhai, you have covered comprehensively and even touched very minutely small important things which are very useful for us being professionals or being in the development sector. As of now, time is over, but because there are some very important questions which members have asked, I can extend the session up to maximum, I can say 3 questions we can take up. Whomsoever has asked the question, I will allow 3 questions to be put before the speaker. Yes.
Dilip bhai, can I ask one question?
Bharat bhai, you can go ahead.
Sir, in case of section 45(5), only individual and HFs are allowed for 45(5). But if there is an LLP who is in the real estate business with object and all, and they have got land and they have given for joint development, development agreement. So what will happen to them?
That will get covered under the 45(2) or 45(1).
So they have to pay the tax upfront.
Yes, sir. No choice.
Even though they are in real estate, they are keeping this as a stock in trade.
It is a stock in trade, then the stock in trade, then the section 28 will come into the picture, no, sir?
Okay. Thank you, sir.
Okay. Yeah. Thank you, Bharat bhai. Now, sir, there is a chat question. Can ITC of tax paid under RCM by promoter on transfer of development rights or FSI under commercial project be availed and utilized against output of 12%?
It can be upfront. It is the only upfront payment, and it can be utilized against the future of the GST liabilities.
Okay. Any other member, please unmute yourself and ask your question, please.
Yes, Dilip ji,
Yes, sir.
Rajesh Dolu here.
Ha, sir.
Yes, Speaker sir, you just mentioned that TDS is applicable on rent paid to the tenant. So need some more clarification on that.
What clarification do you need, sir?
So is the TDS is applicable on rent paid to tenants?
I will go under
Alternate
TDS under
accommodation.
section 194 IC. I will treat it as a part of the specified agreement cost. To treat it as a
Okay.
composite supply. I will not go under section 194I.
So it is TDS is there on
100%. Both the rate of TDS are the same, 10%.
Sir, sorry, sir. That means the TDS is
It's a
applicable on
strategy.
corpus fund as well as rent.
All everything.
Okay, sir. Okay, sir. And it is payable forthwith. Matlab at the time of payment of the
Obviously, sir, no. TDS is always applicable.
Sorry. Okay, sir. And what about, sir, that RCM? We need to pay RCM also on rent.
RCM on a rent, where is it? It is a part of the TDR cost. So RCM goes in a
Okay. It is a part.
No, sir.
Then if it is a part of TDR
Please
cost,
understand my strategy. I have said that I will treat as a composite supply.
correct, sir. And if it is composite supply, sir, and it is a part of TDR, then like others, we are paying at the time of OC.
On the OC, on the receipt of OC.
So then this should also be paid at the time of OC only, na, sir? Then
obviously it will pay. It is RCM on the unsold apartments, no, sir. If it is a sold 100% apartment, then there is no RCM.
Okay, sir. Thank you, sir.
The government has simplified the tax structure whereby it is either 1% or a 5% now. Mostly it is 5% with no ITC.
Okay, sir. Thank you, sir.
Yeah. Any other question, please? I think there is no further question. I don't want to linger the session because our members are very lenient and they have extended the time. Otherwise, I had my experience by the time we have to close. Otherwise, number of members are reduced substantially if we increase the time. At this time, I can see we have extended by 17 minutes, but still members are there. 22 members means it is worth for the members your session. I don't have any word to express because in the 2-hour session and the RERA study group, you have covered the session which really touch various aspects of the real estate, including self-redevelopment, development. You have touched those things which are really matters. Whenever even those who are not into that practice, still they have something in their background. See, what will be the tax impact? What will be the income tax for the members? What will be the GST impact? If something is constructed and ITC not claimed, and how redevelopment cost which is being constructed by the developer and the cost is not recovered and neither sold to the outsider, then to that portion of the cost, this is my question, Nitin bhai, aapko, if the development taken place, builder is constructing, suppose 40% is given to the old members, that construction cost which he has incurred, right? And now he's selling only 60% to the outsider where he's supposed to pay 5%, right? Then what about this 40% construction which he is delivering to the old members?
So that is already provided. No, see, whatever the TDR cost is there. Let us take an example. 100 flats are there.
Yes.
50 flats are given to the existing members.
Correct.
And 50% is sold to the new buyers.
Correct.
So if project is sold 100% before the receiving the occupation certificate, there is no RCM payable. there's nothing. But on the contrary, if the 40%, say out of 100 flats, 50 flats are given to the existing member, 30 is sold to the new buyers, 20 are left out. So on the only unsold inventory, whatever the valuation will happen, he will pay at the rate of 5% based on the nearest sale.
On getting the OC.
Yes. OC or a CC or a first occupation, whichever is earlier.
Got that.
Three trigger points are there, whichever is earlier.
Thank you, sir. Now, I propose a very hearty vote of thanks for and on behalf of WRC of ICI, RERA study group. Sir, we all are the various members from Western region and joined the WRC RERA study group. And at this time, I am proposing a well-deserving vote of thanks to the learned speaker, my friend Nitin Bhuta ji. And please give a round of applause. I also request all the members, please invite your friends, those who are not part of the study group, because having the highest number in the country in WRC, we are not even touched the 100 members in the study group. That somewhere we are lacking to communicate. I think for the interest and for our own strength, we will be having many more demands from the WRC for our betterment, for our fulfillment of knowledge or some different things. So please, at least 5-10 people from your life, please tell them to join this study group. And fees for the whole year is hardly 750 rupees. That is negligible. And the kind of things which we can bring in will be phenomenal. And with this, I declare this meeting is over.
Thank you, sir. Thank you so much, sir. Dilip sir, thank you.
Thank you, sir. Now, Misraji, please close the meeting.
कॉल केला गेलेला नंबर त्यावेळेस नेटवर्क कव्हरेज एरिया म्हणजे संपर्कात होता बाहेर राहिलो.
हेलो, हाँ सुभाष जी, मीटिंग इज ओवर. कोई बंद तो करो उसको. जूम को, हाँ मीटिंग कंप्लीट हो गया. जूम मीटिंग कंप्लीट करो सब. हाँ.